Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is September 20th, and we have Brent crude oil trading down 1% in early trade in Asia this morning, down at 93.42 after a similar correction downwards yesterday. It would appear that the Fed meeting in Washington today and yesterday is making markets a little bit nervous. In some ways, it's a self-fulfilling prophecy. The higher the oil price, the greater the likelihood of a Fed move because inflation goes up. I suppose that's the logic. Let's welcome back to the table some of our three distinguished panelists. Rachel Ziemba, founder of Ziemba Insights, adjunct fellow at the Center for a New American Security. Rachel, welcome your thoughts on, is there anything the Fed can do, 25 basis points, maybe yes or no, that trumps what OPEC has forecast, a 3 million barrel a day supply cut? Nothing stopping this going to $100.
Well, I mean, I think it's more a question of if and when. But look, if we look into the rest of the year, I mean, I'm watching the Fed, but we're still just on this issue of strength of demand, particularly out of China, right? I think we've seen a little bit of discounting of the fears, people sort of baking in there, but I do think the degree of inventory drawdowns, a degree of supply cuts out of OPEC. I think the direction of travel is still upwards. But I think what we've seen here is just a pause along that way. But we're still back to this question of how much sort of oil comes offline, particularly out of Russia. How committed are they to those cuts? So far, they've been not as committed as the Gulf. And I think the other thing that started to happen is maybe people are starting to recognize that the sort of input of new oil from some of the other sanctioned countries, Iran and Venezuela, isn't maybe going to pick up in quite as large an extent. So, look, I mean, I think this is still an element of, but this is still a story where if OPEC keeps with these cuts, and Saudi Arabia has indicated they will, then the direction of travel is to this $100 mark. And I think we will start to worry about countries that have had their currencies weaken and suddenly are facing higher oil prices. What's that going to do to demand? What's that going to do to inflationary pressures? And, I think this makes 2024 forecasting more difficult for the OPEC countries.
Dr. Aman Nasseri, Managing Director, Middle East for FGE Dubai. Dr. Aman, do you expect, after hearing the Saudi minister earlier this week, doesn't seem to be any relenting there? These supply cuts announced, the voluntary ones, as they call them, outside of the OPEC Plus agreement, the commitment there now to sustain them through to the end of the year. Are you seeing any crack in that crystal that would indicate they're stepping back from that?
The cuts that the Saudis announced, the extension of their voluntary cuts in excess of the wider group voluntary cuts that they announced in May, I believe is hard to imagine they pulling back from that. I think it's
even in the face of OPEC's own forecast of a 3 million barrel a day deficit, on that demand will trump supply in the fourth quarter. Even in the face of OPEC's own forecast, you wouldn't expect OPEC to step back from such a steep cut.
Well, the thing is that's OPEC, and this is Saudis. Although you'd imagine that Saudi is kind of driving the OPEC and is one of the, if not the most influential, but one of the strongest voices in OPEC. But I believe that wasn't so surprising or unexpected for the Saudis. I think there is a wider agenda at play, and basically looking at stocks. And perhaps another factor that I can see, I agree with Rachel that the outright prices have some forces and pressures behind them towards the upside. There are certainly some elements that could push the prices toward the upside, but there is a downward pressure on the long-dated Brent prices at the end of the curve, as they have significantly disjointed from the OPEC plus a spare capacity, or OPEC spare capacity, as historical trends show. They have only been away from each other in the long run for maybe 2 months or 6 to 8 weeks, let's put it that way, and we're already passing that period. So there is a correction coming at the end of the curve, and looking at the inventories and the market structure, we think there will be at some point awakening of the market and an adjustment of prices down. So that could have also been kind of seen in the decision made by the Saudis. I don't know. I'm just speculating how and what. I don't think it was Saudis necessarily were unaware of or thought that the market was not going to be in deficit in 4Q. But I think that's part of the overall assessment of the market, including, again, it's the prices are comprised of the long-term dated price and the market structure, and I think there is certainly a downward pressure on the long term, which could adjust prices back down. But that 3 million, as it was mentioned earlier on the screen and discussed a couple of times on your podcast this week, is that part of the range. I know it's OPEC's own demand, but we at FGE think it's more closer to 700-800 KBD, which is between EIA and IEA. So again, the Saudis at least have always said that OPEC is an independent market analysis, and every country has their own assessment of the market, which isn't necessarily in line with the group's assessment.
Henning Gloystein, Director, Energy, Climate and Resources at the Eurasia Group. Welcome back, Henning. We started the year with this dominant narrative that the OECD G7 were going into recession and that China was coming out of COVID. And in the second half of the year, China would save the world as the G7 go into the recession. Is that narrative now dead, or has it just been postponed and could still surface in Q4, Q1?
Yeah, I mean, it's you can see by those forecasts, none of them have kind of quite happened as expected. The US isn't in recession. Even the EU is kind of only teetering on it, but it's not, really in a deep recession. And China's rebound really hasn't happened. So it's disappointing. So it's all like a little bit different than anticipated. And that tells you how sort of unsecure, how we look into 2024. We really don't know what's going to happen. And I think, yes, it is still a possibility that the US goes into recession. It is still a possibility that Europe either remains flatlining or goes into recession as well. And it is still possible that China either recovers or stalls further. So problem is we really don't know. And that is reflected in the oil demand forecast, which Rachel and Iman have both kind of mentioned already. You've got the IEA that forecasts 1 million barrels per day demand increase next year, the EIA 1.3 or 4, and then OPEC goes in with 2.2 million barrels per day. That is an enormous difference. And the reaction by OPEC and the Saudis to this will be very, very different. If OPEC's forecast comes to pass, 2.2 million barrels per day demand increase, which, by the way, we don't think will happen, but who knows, then they can pump again. They'll have to pump again. And then we're really looking sort of at 100 million barrels per day. If EIA's 1.34 million barrels per day increase happens, then we're kind of in the situation that we're in now, sort of maybe, I don't know, $90, $95, tickling 100. But if the IEA's forecast of 1 million barrels per day forecast or a bit lower happens, then I think OPEC will be in a bit of a prickle because there is other production coming online next year. And then they might have to continue cutting right through to the middle of next year. So basically, the disappointing answer is we really don't know. And I think the Saudis are aware of this, and that's why they're not willing to change the course at this stage by just raising output into an insecure output, because they have had experience of doing that in the past, and that causes real price crashes. But the answer is we don't really know what's going to happen at this stage, which makes things a bit complicated.
Rachel, obviously, we do know that the Fed has to continue with its stated mandate to bring inflation down to 2%. Why wouldn't what data point can we look at as to why the Fed would step back from that objective and hence continue to raise rates?
Sure. So the Fed has a dual mandate. Of course, both of those pieces are sort of probably pointing in almost the same direction now. The dual mandate is the full employment mandate, as well as the sort of implicit target. Look, I think the Fed is conscious of not wanting to overshoot, not wanting to lead sort of, hike so much that they have to reverse. They also are concerned about financial stability sort of issues. I mean, we saw earlier this year, sort of along the way to this sort of road that Henning was highlighting, the sort of impacts of some banks that had made quite poor decisions on managing their securities portfolios and what that did to, for example, the venture industry and the like. I think the Fed and other regulators have tried to make sure that others are not in the same boat, and they've done an implicit guarantee of bank deposits. But I think around the world, and especially in the US, there is this question mark about banks and other institutions are holding securities on their balance sheet, and they might not have hedged those fully. BIS has some research out earlier this week that starts to look at whether banks in the emerging world could sort of hedge those risks better. I don't think there's a major financial stability risk in the emerging world from their U.S. Treasury securities right now, but I do think that that other element of financial stability also in the Fed sort of boat. So I don't think that they're necessarily going to pull back, but I think we're in this phase where the big hikes are behind us, right? They're likely to be more, and with oil prices being where they are, that increases that. But I think this sort of question mark is really on the employment side. We saw Janet Yellen yesterday highlighting that sort of the strength of the U.S. labor market, and so I think U.S. policymakers recognize that there's a bit more tightening ahead, balancing all these issues. I think the piece maybe that a number of market actors underestimated was the degree to which the sort of fiscal policy in the US, the industrial policy in the US would support manufacturing. Maybe not quite as strong as the Biden administration would hope, and there's some labor shortages and other issues. But that fiscal policy piece is a different one sort of in this cycle, and some of it is geared towards the long term. And that's something that has made, I think, the US skirt recession for now. We'll see if it continues to skirt. But this is a different. This is a difficult tapering sort of process, shall we say, for the Fed.
Iman, we've seen in recent days announcements for curtailing of exports of products, and diesel in particular. Russia indicating some heavy taxes now to curtail the export of diesel. China pulling back from its export quotas going forward. Where does this sort of obviously crude story has been grabbing all the headlines, but meanwhile, diesel has been soaring up on the inside lane. Where's the outlook for diesel and its impact for adjusting and impacting monetary policy?
Yeah, diesel has certainly had its own interesting ride and roller coaster over the past 2 years, significantly up and then dropped to low tens or teens, and then now back up to $30 and $40 in Asia and Europe. I think as we get closer and closer to the winter, which is the peaking kind of demand and import requirement of Europe, and this year being the first year that Europe is going to experience lack of Russian barrels in its market, as last year basically they still could import and build a significant amount of inventory from Russian barrels up until February. This year is going to the first that they're going to test it, and I think Russia's maintenance season, and basically the fuel shortages that they have had inside has been driving them towards regulating the exports through some tax policy, and basically they're trying to kind of regulate the market. But I can't exclude the possibility of them also trying to basically test their power, or put another extra push on Europe by basically cutting the external supply or export supply down on purpose to basically also push back or respond to the pressures put on them by West through different mechanisms. But obviously, China has the power to take a big role in that by through their incremental exports. I think the export quotas that were given did a little bit of easing in terms of pressure for cracks in diesel cracks in Asia. There is still some ambiguity and expectation that there may be some flexibility in swapping fuel quotas, fuel oil export quotas with gas or diesel, and that could take another pressure off. But I want to emphasize that one element that the market is right now looking at, and as we speak, we're finalizing a note to send out to our clients, is the role of Middle East here to help Europe this winter. And we know that the market expects incremental volumes from Kuwait, from Algiers, which is ramping up their supply. Duqm is testing and about to join the market and has some more diesel supply coming out. There are definitely some concerns about the Saudi also maintenance in October, November, December for some of the refineries that have high diesel yield and usually and historically been exporting volumes to Europe. But I believe that could be partially, if not fully, offset by the impact from the new volumes. So I think we will see Europe still elevated the prices, but we may see some again another downside on the Asian cracks as the market kind of adjusts to the impact of Russian, or clarity about how the new policies will impact the Russian supply, and Russian refineries eventually coming back to the market, supply from the maintenance, as well as again more understanding of the Middle Eastern volumes filling some of the gaps in Europe.
Henning, on that point, I mean, the sanctions now seem to be the price cap. We see the Iranians pretty much pumping as much and exporting as much as they can. The Russians getting all of the oil they want to market. Where are sanctions? Where are the price cap? Where are any of these as relevant to the market at this time?
Well, so I mean, on Russia, the main argument from the Western point of view was to try and cap the price without disrupt the global market. One can argue how well that's worked, but for sure that was the idea. So the Iran sanctions is a bit of a different beast, I think, because when this crisis started, it became apparent that you can't sanction, so many oil producers in the world. This is particularly from the US point of view. You can't sort of stop importing from Russia, sanction Iranian oil, and then Venezuela on top of that as well. So I think there was a bit of a diplomatic drive to try and find solutions elsewhere, which I believe is ongoing with Iran, but it's still stuck. But it probably means that there's a bit of a blind eye to a big turn to Iranian supply, especially to Asia. Now, as with regards to Russia, very difficult to understand from the outside what's going on in there. But it's worth keeping in mind, as we are heading into the next winter, Russia still does have a few cards to play if it wants to. We've already heard on the diesel side, that's actually where it hurts most, where heating oil is an important fuel. Diesel itself is an important fuel, especially in Europe. And of course, the Russians are still sending liquefied natural gas, LNG, to Europe. Not state controlled, it's via Novatek, but I suspect that if Russia wanted to sting Europe in this winter, this is where it could. On the other hand, of course, next year, if the Europeans come through the second winter with the loss of most of Russian natural gas, and they realize that they're still that they can probably get through this third winter in a row, in 23-24, that they might actually target Russian LNG imports as well. So there's still a lot of, we haven't seen all through the sanctions embargo capping game yet. And that's a problematic situation. As long as this war in Ukraine goes on, there will be a fallout in the energy sector, which will be felt not just in Europe, but around the world.
Let's go to the survey question. We're sort of addressing some of the themes earlier. Nothing the Fed does on raising or not raising rates 25 basis points can trump a 2 to 3 million barrel a day oil supply deficit in Q4, propelling Brent to $100 a barrel. Agree or disagree with this statement that the Fed, while headline grabbing, it cannot trump this massive, at least forecast deficit, depending which of the different agencies you want to follow. But OPEC themselves have said 3, IEA have said 1.5, FGE are now saying 700 or 800. Where do you see this deficit, and does the Fed have any power to trump that? Agree or disagree with that statement? Rachel, of course, the other sort of big news that all of this triggers is the elevated gasoline prices in the United States. The price at the pump, as they say, for this time of year is at very high levels. And so the trajectory of what it tells us going forward, that they could go even higher. How does that play out? Is there anything that could stop that continue to rise? And the politics involved last year, or the year before, last year, we saw the administration sort of release from SPR in order to try and impact the elevated prices. Successfully, they did, whether they played a role or not. But where do you see it going this season?
Yeah, and I would say arguably the sort of political sensitivity around the gasoline prices is maybe even greater than the direct impact of rising sort of gas and fuel prices on the inflationary pressures, right? The sort of Biden administration sensitivity is perhaps even greater than the Fed's, and the like. I think the direction of travel, just catching up to where crude prices have gone, and these stories more globally in the product markets are that it's going upwards. We could see levels where the administration uses the SPR again. This is probably where it's unfortunate they didn't get their act together to figure out how to refill earlier in the year. And I know on this podcast we talked about that. In that sort of context. Look, I think a lot of it really does depend on how all these supply demand factors we're sort of talking about, play out, how the sort of continued hurricane season, if that leads to sort of any shortages in the Gulf, sort of off the Gulf Coast. I mean, those are sort of localized stories, but the direction of travel here. And I think putting things that Iman and Henning have said together, I think this sort of dynamic of the sanctions, the leaky price cap, we're still in an environment where the sort of shipping time, shipping costs, other sort of frictions in the market, fuel is going a farther distance in general. And I think that only adds to the price to the end user. And that's a story not only sort of in the US, which of course does does do some refining at home, but I think that's a global consumer challenge. And it's particularly challenging in places where the currencies have been weakening against the dollar. So they face both a higher oil price and the purchasing power story. And we're going to be seeing the demand signs from that, I think, as we head into next year.
Dr. Iman, last winter, we saw the sort of competition for gas and oil, and the idea that the elevated gas price was, had its impact on pulling away from the heating fuel and the crossover of the two over the last two winters. We're seeing now, as we go into this winter, the LNG price now elevated into the teens already, high for this time of year. Where's your outlook for LNG and for the possible crossover as oil and diesel remains quite high?
I want to keep my answer to this question brief and make a couple of comments regarding dialogue that we had here. I believe this winter will be different from last winter, as the extent of LNG prices and gas prices are not as high as last year, but rather we have
Not yet.
diesel. Not yet, but we have the diesel prices very high, and so the switching economics is not there, and certainly not as favorable. If you look at the high gas prices and compare it with the diesel, is not there. Plus, we believe that the market almost exhausted all of its low-hanging fruits and easy solutions to switch from gas to diesel and liquid fuels. If anything, we may see some of that to be reversed where the supply is there. So that's my quick answer to this question. One feedback and comment I wanted to add to my answer regarding your question about the Saudi cuts is that one consideration that could perhaps be taken into account in here is next year's balances and basically the cuts requirement. If we assume that the Saudis will keep their 1 million barrels per day out of the market until December, I'd want to put it back in January. Our current balances, very kind of gloomy demand picture next year, which is 1.4 million barrels per day year-on-year growth versus 2.4 this year in our books, basically. And China's part in that 1.4 million is only 400 to 500 KBD. That makes the situation for OPEC Plus and Saudi very difficult. So if Saudis were to unwind even at the end of December, that could lead to a significant build next year, especially during the first half. And hence, our forecast is not only they will most likely keep it until the end of December, but also probably well into next year. And currently, we have it, half of it at least, retained during the first half, and maybe the other half kind of unwound, or the second half unwound second half. And that still leaves us with 200 to 300 KBD build across the next year. So one bigger problem is that it may not be as easy to keep the basically switching on and off, and hence they have decided that extending it because of the situation next year is going to be an easier digestion for the market, as opposed to them putting it back in October and then pulling it out again in January. So
Yeah,
that's,
you would think
that's
if they have held the cut through the sort of peak demand period for Asia in the fourth quarter, they're unlikely to bring oil back in the weak demand window of Q1.
Exactly.
Henning, closing comments to you with the survey result, but they agree the Fed raising rates can trump nothing the Fed does can trump. We'll post that on social. But Henning, I wanted to get your thoughts on where we talked about the sort of the price cap, slightly irrelevant these days. The sanctions seem to be more about letting oil flow than stopping it. And now we go into the second winter of the war in Ukraine. We've got the Beijing, Putin and Xi announced to meet next month. It seems that relationship is getting deeper and the war is becoming sort of background noise. Your thoughts on where we are going into the second winter of the war in Ukraine and the growing relationship with the Russians and the Chinese?
Well, it looks nasty. The Ukrainian counteroffensive over this spring and summer, it's made some advances, but not the advances that Kyiv was hoping for. Russia has really got itself stuck. They've defended very, very successfully. That means now sort of the winter season comes. We saw the last year that there's much less movement. That doesn't mean less dying, because they're still fighting very intensively, but there's less movement. The Russians seem to be getting some support, maybe even from North Korea now, after Putin met Kim Jong-un in Eastern Russia a few days ago. The Ukrainians are still getting support from the West, at least until next summer, to the US elections. We'll see what happens there. So sadly, this all points towards another winter of brutal fighting, which is terrible for the people in Ukraine. And there doesn't seem to be any realistic option for a credible form of a ceasefire at this stage, which is not nice.
And we'll have to leave it there. The war goes on, and as it goes on, it seems to increasingly have little relevance to the oil markets or less relevance, and consequently oil prices not being part of a solution or a growing pressure to resolve this conflict. I'm sure China and India are in no hurry to stop enjoying discounted Russian oil, for example. Let's just acknowledge that Brent is again trading down this morning. WTI also down, holding just above $90 a barrel. We have a great interview just published, halftime talk with Dave Ernsberger, head of market reporting and trading solutions at S&P Global Commodity Insights, giving us his top takeaways from APEC and an update on the performance of the Brent benchmark 3 months into welcoming Midland WTI into the basket there. So some useful insights for market actors to listen to that 20-minute interview. All the best. Thank you very much and really appreciate it, Henning, Rachel and Aman, for your insights today. All the best.
Thanks, Sean.
Thank you.
Thanks very much. Have a good one.